Ted Schlein is managing partner at Kleiner Perkins. Welcome to Bloomberg West. So, as I said, you have seen a lot. You lived through Google's IPO. You said a year ago that we were in the second inning of digital. Where are we now? Is that inning over? Is it still going?
I think this is like Silicon Valley 3.0. 1.0, the PC, 2.0, the internet, and 3.0 is the mobile internet. But what makes it so different and why there's so much activity going on is we have social media coming together with mobile, coming together with local services. And the convergence of those three trends are leading to an enormous amount of innovation, activity, and entrepreneurship, unlike anything actually I think I've ever seen.
So when you look at the convergence of all of those trends, there's more startups out there than ever before. How do you, as we've been talking about earlier, separate the signal from the noise? Where do you see the best opportunities?
Well, the best opportunities, it sounds trite, but you're obviously going after large marketplaces with great entrepreneurs. And it's the ones that know how to leverage the social media fabric in whatever consumer offering they're presenting to the customer. And that takes its place in all mobile investments today. It's taking its place in any consumer-facing internet companies today. And it allows you to do very targeted services. Keep in mind, before we had to be right about the big platform, which search engine was going to win, which e-commerce, Amazon, was going to win. Now, because of the ubiquity of the internet and the fact that people can get on it from all over the place, you can do very targeted consumer services. Things like Chegg around renting textbooks, or LifeLock around identity theft protection. And they can be very big. That's new. So the ability to target, because of the ubiquity, and create very large companies is a pretty new phenomenon.
So talking about trying to find those big wins, Dropbox just raised a big round today, Greylock and Index, later stage. KP has invested later stage in companies like Twitter and Groupon. Why are we seeing more traditional VCs doing that?
Well, you're seeing an opportunity to enter into a company at multiple stages of its development. Traditionally, Kleiner Perkins and some of the other venture firms you named are pretty early stage. We are seed investors, Series A investors, and that's still what we mostly do.
And isn't that ideal, because then you can help shape the companies as they grow?
That's the value-add services a venture capitalist brings to a board and an entrepreneur. Is how do you help recruit the right teams, put the strategy together, help them grow to become big companies in the future. But the later stage growth opportunities are coming along where you either might have missed something at the early stages and you wanted to get involved, or you just see an investment opportunity for your investors to make money. And so you'll enter in at a higher price with still the opportunity for upside.
Now, you guys are in most of the big names, Twitter, Groupon, Zynga, Facebook.
We try hard.
Let's talk a bit about Facebook. There was a report a few days ago that for the very first time, 0 Facebook shares sold on the secondary markets. Any concerns there about creating liquidity in the current environment, harsh economic conditions, market volatility?
My comments aren't really about Facebook, but it's about the concept of secondary markets. I think it's very important for investor and entrepreneur and management teams to stay aligned. And the rise of these secondary markets have allowed employees and entrepreneurs to sell shares in a relatively illiquid marketplace, where you now have a divergence of interest between entrepreneur and investor. I don't think overall that's healthy. And you're doing it in an environment where you have a disparity of information between buyer and seller. That will probably lead, my guess is, to some form of regulation in the future, if it continues to go that way. And so I generally am not a big fan of the secondary market.
So you think that secondary markets can be detrimental to these companies? A lot of the companies that you're invested in are, Twitter just did a $400 million secondary round.
Well, secondary rounds are different than secondary markets.
But it's to cash out employees.
And that's going to happen, and it's going to, it's probably going to continue to be a trend. I do think, though, that if you try and institutionalize it, which is the concept of the secondary markets, who, by the way, have good businesses and they seem to be doing well, I think you run the risk of management teams and board members and investors starting to diverge in what their ultimate goal is, which is to build a big, valuable, sustainable company with the eye towards how do I create future value, not take value off the table too early.
Now, talking about teams, Mary Meeker, longtime tech analyst, joined you guys about a year ago. How is she fitting in? Where is she fitting in? I know she just presented at Web 2.0 today.
Mary's great. We're all these guys that came out of operating roles and get involved at the very early stage of venture building. And Mary comes in, queen of the internet, been involved in almost every major consumer internet trend and company, really, that we know of today, and bring her viewpoints to these ventures at their later stage. What CEO wouldn't want that? Who wouldn't want Mary Meeker associated with their companies and working with them as they plan to go public, as they plan to go to that next stage? From our standpoint, she's just a pleasure to have around the office. She's taught us all about things like discounted cash flows and stuff that we don't typically do at the very early stage.
Now, talking about the later stages, one of your portfolio companies is Jive. They recently filed for an IPO despite this talk of market volatility and that the IPO window had closed. I mean, do you think there is such a thing as an IPO window, or can good companies go out whenever?
I used to say, because it's a pretty trite thing to sort of say, good companies can always get out. We've never seen the market volatility like we've seen the past bunch of months, and it causes a level of pause because investors don't know how to value a new offering and a new issue. And so you have seen a virtual closing of the marketplaces, but there's a pent-up demand from high-quality companies that are getting ready, we believe, to be public companies. And I do think they're going to get out. And I do think that there will be a window for those companies that are at the more mature end of the scale.
And we're seeing a report that Groupon, which has been, of course, a very controversial potential listing, is planning to start its roadshow next week. Do you agree that even a Groupon should be just going for it and going strong?
I'm very happy for Groupon.
All right, we'll leave it there. Now, let's talk a little bit about security. I know you used to work at Symantec, and security is one of the areas that you're very passionate about. How would you describe the kind of threat level that we're facing now?
It's the highest I've ever seen it. And I've been in the security market for 25 years. I've worked on all sorts of security companies and technologies. The amount of data and information being stored at large corporations on behalf of individuals or on behalf of those companies is growing exponentially. Where there's data, there's crime. We grew up basically building companies to be like M&Ms, right? They're hard on the outside and nice and soft and chewy in the middle. And that's how they did their security. And people figured out the bad guys are pretty smart. They figured out how to break through that outside shell to get at what they really care about, which is the information and the data. And that goes for foreign nations as well as for people after the money. And you're seeing more and more of it. It is no surprise that the number of breaches are just increasing by a very rapid rate.
All right, and I know you guys are invested in some of the up-and-coming security companies as well. All right, Ted Schlein, managing partner at Kleiner Perkins, thanks for joining us here on Bloomberg West.